First is, why do we need equity? Why do we need equity to be a part of total compensation? The second part is really around alignments amongst a group of stakeholders, right? That have something to do with the long-term incentive plan. So how do we drive that alignment? The third piece really around the dark side of LTI, right? Oftentimes the program does not deliver money, right? So what do we do to manage the dark side of LTI? And the last is really around how to really make the plan successful. And then some concluding remarks from Vamsi in terms of his experiences and any specific practices that airtel that you want to maybe talk about. Time permitting, and depending on how much interest you take, we could also allow for a couple of audience questions. So broadly, that's the setup for this chat. Let me start with the first section, which is around why do we need a long-term incentive plan. So a couple of data points for you all, right? A third of the companies do not have any kind of a long-term incentive or a equity compensation plan in place. Data point number two, some of the companies have also discontinued a long-term incentive plan that they had, right? The way we look at the programs at this point in time is that we're trying to copy paste from other companies. We're trying to understand what this is or this is not, and then accordingly try to adjust to our organization and make a long-term incentive plan out of it. It's more like, if you're following the fashion or the pattern to say, others have a long-term incentive plan, maybe I should have it too, right? So Vamsi, my first question in this context is, why does one need a long-term incentive plan? What is the problem that we're trying to solve with it?
Yeah, thanks Navneet, and thank you Capita and ESOP Direct and Compport to set this up. When I reflect on the need for an LTI scheme, right, or an LTI plan, so context comes into a very important thing in terms of why a company should really look at an LTI scheme. Second is the relevance to the business plan. For example, if you look at the life cycle journey of a business, right? If you have to break it into three parts, which is the startup phase, the incubation startup phase, the growth phase, and the mature phase of a business. So the context in each of these stages would be very different. And again, stepping back to if a company is in a startup incubation phase, why should an LTI be there will have a very different need versus the other two phases. In a startup incubation phase, it's more of how do you really attract the founding team? How do you make sure that you have the right talent getting onboarded? You might really not have a clearly defined long-term business plan. You might also not be at a stage where your product market fit is finalized. So that's a very early stage where you don't even talk about what's the valuation of your company, right? It's more of how much sweat equity would you give to your founding team, so that there is clear skin in the game, and you also want that team to really take you through that particular journey of 0 to 1. So if I again have to look at that particular block, over there it's more of really getting in the right talent on board, be it tech talent, the business talent, the talent which can really help you to navigate that journey. In the other two phases, the requirement would be very different. For example, if I take the other extreme of a business which is very mature, like I can give you an example from Airtel, right? Within Airtel, while Airtel is a behemoth in what we do in terms of the mobile space, we also have a lot of incubation businesses within Airtel, especially from our digital space. If you look at our Airtel Payments Bank, for example, it is still in a fairly nascent stage of where it is in terms of its growth. If you look at our data center business, so that's something which is hardly 3-5 year old company. So the requirements there versus a clear, stable mobile business for us would be very different. So in a mobile business, the need for us is not that 0 to 1 journey. It's more of how do we really get the incremental growth, right? How do you get to deliver on certain input metrics? May not be a clear output metric that we are chasing. For example, it could be a simplification of a customer journey. How do you now enable that through a reward over a long period of time? How do you stick to your ESG goals. So if Airtel wants to say become net carbon free by a certain milestone year, how can that be achieved in the long term? So I think the context and relevance kind of changes. Going back to your point around, is it a fad? I would say it will be a fad if you don't really look at the basics of why do you want to do it. That's how I see this.
So Vamsi, if you reflect back further, and the portion of companies that I highlighted that do not have a long-term incentive plan, or the ones that have discontinued, there is no empirical data to prove that the growth for those companies is slower, or performance of those companies is weaker as compared to industry peers, or attrition in those companies is higher as compared to those that have a long-term incentive plan. So what's your take on it? Can companies do without a plan altogether, or that's not an option on the table today?
Companies can definitely do that, right? So again, LTI is one component of your total reward strategy. So it all depends on what is your total reward strategy, where do you really see an LTI fitting in, is there a good pseudo lever that can really replace the need for an LTI, right? So LTI addresses three parts of your requirements. One is how do you really attract talent, how do you really drive performance, and there is a hybrid in between saying how do you do both, right? So typically these are the three reasons why companies do an LTI. Now, again, if we have to look at the timeline of each of these, a lot of times companies mix a short-term goal with a long-term goal, right? And a lot of times the metrics that are actually chosen for an LTI scheme, they are very much in line with what a STI scheme will also deliver. For example, a revenue market share. That's something which your annual performance bonus can also take care of, right? So, again, if a company is able to really define the long-term North Star and wants to have that stickiness over a long period of time, and the company feels that LTI is the right instrument there, you can definitely do it. But otherwise, there are cases, in fact, a lot of companies, in fact, we ourselves do it, right? We also do a lot of deferred cash payouts where we link it to a certain tenure. We say you stay for with the company for 3 years, you get it 100% over a period of 3 years, etc. So it works. There is no magic pill which only LTI kind of solves. The one big difference which LTI brings in the context is how can it beautifully align with shareholder interests, with organizational interests and employee interests. That is something which probably a cash won't do, right? Especially if you are chasing growth more from how are you aligning it back to shareholders, right? LTI is a very powerful tool. But again, over there, are you linking it to the right metrics? If it is, say, deep discounted, then how is it aligned back to a shareholder interest? Like previous panel has also touched upon the proxy bit as well, right? So there is an increasing scrutiny around how shareholder interests are actually married to what company is doing from an LTI scheme. So there is a clear prevalence of how companies are now segregating plans between RSUs and PSUs. There is an increasing trend towards companies moving towards clearly saying that, okay, my stated objective here is retention, hence I would do an RSU. And again, why do you need to do an RSU at, say, the top management level, right? Because those are the folks who would have an ability to influence your outcomes. So there is a clear discouraging measure in terms of why should you really have a retention scheme there? Why can't it be a PSU? So it's a mix of some of these things which come into play.
So in fact, the last part of what you said around different stakeholders, right, which beautifully sets us up for the second section of our discussion, which is around aligning stakeholders that are there, right? So investor to the promoter, to the board, to the employer, to the employee, to the CEO professional that is there on the ground, and then to the regulators as well. It's really complex to solve for this, and maybe that's for another day. But if you were to just pick up two stakeholders in this entire equation, which is the employer and the employee. So the employer is willing to give LTI for the employees to also take a bit of a risk, right? An employer wants to provide LTI for the employees to drive performance for the organization. However, on the other side, the employee's way of looking at long-term incentive is to say, no business risk should define my LTI payout. And it's my birthright to have a long-term incentive at play. And 100% of the money that you want to give me should be given to me in fixed. And anything that is variable should be over and above, or a long-term incentive should be over and above. I'll give you another example. Back in the day, go about 20, 25, 30 years maybe, a lot of organizations used to provide benefits like company-owned accommodation or a fancy car at leadership level. I think somewhere long-term incentives have become that new benefit. So the company car and the company house has been replaced by a long-term incentive program. So company employees see it as a benefit as opposed to a compensation that is linked to performance. So how do you really marry the varying interests, opposite interests of the employer on one hand and the employee on the other?
That's a great question. And when I look at my own experience across a startup and a MNC and a Indian organization, right? So you are right, Navneet, in terms of this particular confusion around. In fact, see, LTI is in itself a fairly complex instrument. It is not very simple, right? At least from it's definitely not as simple as cash, right? So the biggest obstacle that employees have is to really understand what is an LTI scheme. Because, and we as HR professionals and the way we also construct this is, we also use a lot of jargons in ESOP LTI, right? We say stock appreciation, SAR, phantom. So we use a lot of fanciful terms, so to say. Now the question is, do people really understand, relate to this, right? For people to really appreciate this, firstly, I think organizations should keep it very simple. And it shouldn't really confuse with multiple objectives, right? Okay, what, say, shareholders are saying, what companies are trying to achieve. So if you have to break your workforce into different categories, which is, if you want to say broad base your ESOP plan, like for example, airtel has done it, right? Earlier we used to just give it to the senior leadership. Now we give it to our middle layers as well, especially in the digital talent. So over there we keep our plans very simple. We say it's a cliff 2-year vesting. You will get this after end of second year. There is no performance related to your individual performance. It is a company performance which is linked to your delivery of your LTI. And it is a fairly predictable way in which the share price also kind of operates. So for us, it's easy to really say that, okay, this is a reward for you beyond what you get as fixed pay. And by the way, we also don't have a performance bonus for these folks, because we believe that for tech talent, there's no need for us to give an annual performance bonus delivery. So the way we have crafted the total reward strategy, there is fixed pay, which is competitive. Then there is LTI, purely as a retention lever. You stick with the company for 2 years. And we also appreciate that gone are the days where people, especially in digital tech talent, would stay with you for 4 years, 5 years, right? So we do refresh grants and so on. So that way, it is fairly simple for people to understand, and people appreciate it. Now, I'll also take a contrarian example of where it did not work for us. In a startup, we tried to really define annual goals and said that, okay, if you achieve a certain metric, you will get this LTI. Now, the challenge there is, in a startup, it's very difficult to define an annual goal, right? In two quarters down, you don't know how is your service offering really going to change. Is that the goal that you are going to chase, or there's something else? So all metrics will not really apply there. Over there, people will then get confused, saying, what are we trying to chase? I have been given a letter 2 quarters back that there's an LTI which will come to me, but I'm no longer even chasing that goal. Even company doesn't seem to chase that goal, right? What is going to happen with this LTI now? So, hence I would say that you should operate with the context, again, where you're operating, and keep it really simple for your people to understand.
Got it. And again, that brings us to the third section beautifully, which is to say there is a dark side to LTI, right? And the challenge or the issue is more complex in unlisted entities as opposed to listed ones, because at least there is a share price to things, right, over there, and rest is all valuation linked and which can be looked at differently by different stakeholders and different parties as well. So, you know, a couple of points there, right? One is there, the challenge of transparency there exists. Plans are not that transparent, and even senior leaders do not understand how exactly do they work. And sometimes information is not shared in the capacity that it should be, for maybe the right reasons or not so right reasons also sometimes. The second is that there is excessive risk taking, right? So the goals are stretched and the risk is very high. You yourself mentioned that organization goals and plans itself change, and then how do you look at delivering LTI through the changing plans, etc., becomes the issue. The third is performance conditions do not get met sometimes, and that leads to no payout at the end of the period. And that leads to angst and anxiety amongst employees. And even, I would say, organizations are not happy with it when that happens, when, you know, the plan goes underwater or does not deliver any real value to employees and so on and so forth. So in this context, what are real problems with plan design, with plan execution, and I would also say communication, that lead to these issues around LTI being not being delivered?
Yeah, so if I have to look at this on a XY axis, right? So on one hand, if you look at the shareholder interest, second is the value creation. Now, picking the right metrics on how you measure value creation is going to be very critical. I would say the real value creation metric would be, maybe the ultimate value creation metric would be how your share price is really doing in the market. However, that's a very mature way in which you look at your metric, right? A lot of times you really do not have control of it because of market conditions and volatility, what's really bringing the price up and down. Now, if you go back to your operating metrics, that's where you'll have to pick the right metrics on what you would want to chase. For example, one thing which really worked for us in the past was we did not really operate on annual goals. We've said there is a North Star goal. You achieve in whatever time you take. Like if you achieve in 3 years, it's well and good. You achieve in 5 years, that's fine. But you get disproportionate wealth creation. It's a 5x multiple that you get based on if you achieve that North Star. And there is, of course, an expiry of, say, 7-year period. Within these 7 years, whenever you achieve this, you get a 5x multiple. So that way, what happens is it also takes care of that moving goalpost of when do you kind of achieve. But clearly, say, if you want to get to a $1 billion valuation, if that's the metric that you would want to chase. Whenever that happens, that kind of triggers. So you link it to that kind of goal, but again, you can't do it for your broad-based population, right? So this is something which you can do it for your founding team or the incubating team for the particular business. For stable companies, it's fairly straightforward in how you measure value. And that's something which all boards are mature in terms of how they really set the target metrics. I don't see that of too much of a problem there. Over there, it's more of, are you having the right delivery vehicle? Is it deep discounted? Is it partially discounted? If you are linking it to market price, then how are you making sure that people see the upside consistently? Because once you make it market linked, the con side of it is also the predictability will actually go down on how much people would make. But that's the risk which is coming with it, right? So as long as in the total rewards philosophy, again going back to what's the intrinsic worth of the job, that's paid through the fixed pay. Anything above that is something which is variable in nature. And your annual performance is for your in-year performance, your long-term performance is measured through your LTI. So if that is clearly crafted and communicated, then I don't think there is an issue in doing that.
Okay. The last part that I want to talk to you about was how to make the plan deliver value to the organization and to the employees. And you know, really two questions there. One is to say, when you are designing the plan, at that point in time, how do you stress test the plan to make sure that it will work? That's one. And secondly, when the plan period is over, how do you reflect back and figure out the goals are met or not? and the value is delivered or not?
Yeah, that's a great question again, Navneet. So one, I think when you design the plan, it is very important to look at the type of people you would want to give ESOPs or an LTI, right? So what we do and what has really worked for us is we look at it in a framework. We look at our critical jobs or critical roles in the company, which we clearly feel will add substantial value to the business. And second lever we also look at is how do you build leaders for future, which is take a long-term approach and say, okay, this is my leadership layer today, and I would want to build my leaders within, successors within. So do you have the right set of LTI for them? So critical roles, critical people. Now, if you put that in a framework and put talent to value, you clearly get a framework around who is sitting in what quadrant, right? And then you decide what kind of delivery vehicle that you would want to do from an LTI standpoint, which would mean if there is a person who's doing a critical job and also is a succession for your future leadership roles, you would really look at the person from a ring fencing standpoint, because that's the objective there, because the person is already doing well. It's more of making sure that you are building that stickiness for the person there, versus somebody who is in a critical job and may not be a succession, but really driving growth for you. So over there, the design or quantum, the vehicle that you give, the kind of vesting conditions that you would link can be very different. So I would say that is what you would look at when you design the plan. Effectiveness, of course, attrition can be a good measure on whether it's
for
really
that
working
population that was
for
covered.
that population. Second measure that you can also look at is the wealth creation opportunity. What is the stated objective when you design this plan, versus is it really giving that potential upside for the employee? And of course, is it really translating into the value that you wanted to create in the first place from a business standpoint? So that's how I would see it.
I do have one last question for Vamsi, but I'll hold on to that one. I'll open it up to the audience to check in case you have something that you want to ask.
Hi, Vamsi. So Airtel has a LTI plan for many years now, right? Yes. And you mentioned that there are more businesses coming in which are in incubation phase. So firstly, how has Airtel's original plan, the group plan, has evolved in the recent past, and how different is it from the plans for, let's say, those incubating businesses?
Yeah, so our ESOP plan actually is now 22 odd year old, right? So it's a fairly old plan that we have. In fact, we had two plans, one in 2001 and 2005. So the way we looked at is our scheme. So our scheme is different from the plans that we have. So our scheme is something which is holding ground since last 18 years now. We haven't really changed the scheme per se, because our scheme gives us flexibility to create our own plans each year. So coming to your question around the incubation business's digital talent, what we have done is we have rolled out plans within the scheme linked to a certain objective. For example, our digital talent, as I said, has a LTI plan of 2-year cliff vesting. Our regular LTI plan is a 3-year vesting, which vests over a period of 3 years equally. So it's a fairly simple plan that we have. We also have a plan which has a 100% cliff vesting over 3 years. So we have that flexibility to create it. Yeah.
So, hi. So when organizations are typically moving from an ESOP hardcore plan to more of a advanced level restricted stocks or SARs or all of those, so how is employees perceiving those, and what all things can, as an organization, as HR leaders, we can do in terms of increasing the impact of that? And when there is a shift from an ESOP to an RSU, what is the impact on attrition, retention, some of those metrics?
See, I would look at it more from defining the pay at risk at an individual level, right? So you can actually call it as ESOP or an RSU or phantom, anything that you may want to term. But if you have to really break down the compensation of a person into fixed pay and what is the pay at risk, right? So as long as the fixed portion of the pay is something which is intact. The variable part of the pay is where you can actually change without really creating a negative impact on the person's potential earnings in terms of what the person would get irrespectively.
What do you suggest companies should do to create that always daily, weekly, monthly, annual excitement about these plans? That's the big gap, I think, in the companies.
Yeah, I agree. It's a big gap. See, there's no magic pill to what you have asked, right? So I think it's going back to basics and doing communication, reinforcing that communication time and again. Also create tangible outcomes, especially in unlisted companies. Can there be buybacks so that people can see some value in what LTI is really delivering? But see, the challenge also in doing some of this is, are you really diluting the objective of why you have an LTI in the first place? So you can do all of this, but also keep in mind that when you do some of these things, it should not really dilute the stated objective of your LTI plan. As long as that's intact, you can have a lot of creativity around how you can do this from an execution standpoint.
Last one, and this is not just for you, Vamsi, it's for everybody out here, it's for the ESOP Direct team as well. Cash is more expensive than equity. That's very clear, right? Cash is far more expensive than equity. What is that magic number to say, if I were to sit in front of an employee and say, here are two options, right? Either I give you 1 rupee cash or I give you 1 rupee LTI. The answer is clear, the employee is going to choose cash, right? But we say this 1 rupee on LTI side can translate into, typically you take a multiplier of 2.5 times. You'll say it'll be broadly, I don't know what the industry norm is, but I would imagine somewhere around 2.5 times is what, let's say, delivers as an example. So if that be the number, you say now 1 rupee of cash, 1 rupee of equity today translating into 2.5 rupees of equity tomorrow. What will employee choose? Will they choose 1 rupee of cash still? Or will they choose 2.5 rupees of equity? Or if they'll still choose cash, what is that 2.5? What does that 2.5 need to be for the employees to choose equity? So that's I don't know whether I'm able to articulate or not.
No, I think that's a great point. In fact, we have done something like this a few years back, where we have taken few examples of people who have really created wealth. Because see, wealth creation only happens through ESOP LTI, right? Of course, cash can also deliver wealth, but the value of compounding kind of kicks in when you give LTI. And we have actually shown certain examples saying, okay, today you take cash and you take LTI. Let's assume certain compounding growth rate over a period of time, and valuation goes up and you keep getting refresher grants over a period of time, and you'll also keep getting cash. The value of compounding kicks in such a way where over a period of time, it's like we have all seen that, right? 0.99 to the power 365 versus 1.01 to the power 365. It's as simple as that. Over a period of time, if you can articulate that, yeah, nothing like it.
And you know, furthermore, sorry, I just come to that, just to complete that point also, I think the reason why I also ask is, say, can we look at a model where we make LTI flexible? We've spoken of flexible compensation in the past. We are talking of flexible benefits. Can we talk of flexible LTI to give the employee two options to say, here is 1 rupee of cash or 1 rupee of equity. 1 rupee of cash will be given to you at the end of 4 years, it will be 1 rupee of cash only. But 1 rupee of equity given to you can translate into 2.5 rupees of cash, and let the employee choose.
Can do. The challenge will be, it is difficult to execute and administer. Yeah, but it's definitely it's definitely something which is possible for sure. We have explored something like this, but challenge also is around how do you really deliver, administer, execute. Are you really making it too complex, right? So we kind of left it there. Yeah.
Hi, Navneet. I'd like to give 2 minutes, real life instance, what we experienced in our finance corporation. So that was an assignment we undertook in year 12. And because that is a PSU, there is a guideline from the ministry that even the cash incentive should be given, ideally should be given in the form of ESOP, to which we got a resistance from their employees, because that is a PSU. They are not very much familiar with the ESOP term. So what we were required to do, we had created 2 desks. I'm talking about PFC. I'm talking about, this is a very real life example. I mean, company had given a clear choice. There are 2 sets of employees, or there is a group of employees. There are 2 desks, cash desk, equity desk. We have done a simple ESOP program in 2012, and time is sensitive. 12 is important to know. There were 2 persons, Mr. A and B. Most of the persons, or say 50% persons, came forward to get the cash of 1 lakh. Another person, Mr. B, took equity worth 1 lakh. Now, 13, there was unprecedented move in the market. Now, I'm talking about 2013 October case. Mr. A had got the net wealth, I mean, 1 lakh rupees plus FD rate of, say, 9 or 10% or whatever, 110. But Mr. B had got the wealth, I mean, he has created that, I mean, 3 lakh rupees. And that has created wonders in that. And this is the real life example. We had seen that. So just thought.
I mean, we all are aware of this. I think we are just running out of time. And maybe one last one from your side.
See, it depends upon the risk profile of the recipient. So if you look at junior levels, their preference for cash incentive will be greater as compared to someone at a senior level or a function heads level, CXOs level basically, because there the risk appetite is more for equity incentives. So it also has to be seen from the risk of the recipient, which instrument will work for them. So it also goes back to the planning part, that when you are doing a ESOP program, and this aligns with your stakeholders, balance, that how much pool to set aside. You might not need LTIP for the entire organization, the same set of incentives, whereas you can bifurcate into cash and equity. So that's one element which needs to be thought upon during the design phase.
Vamsi, I don't have anything else, and closing remarks, thoughts from your side.
No, thank you. I think this is a great forum. As I see, I've also learned few things from this discussion, and of course the previous discussion as well, getting very diverse views around how ESOPs can be looked at, how LTA can be looked at, right? So I would thank Capita, ESOP Direct and Compport for inviting me.
Thank you so much. Thank you for that. And just, closing thoughts from my side. One thing we need to understand is that the basic strategy of raising children, teaching students, and managing employees or workers can be summarized in 6 words. Do this and you will get this. Yeah? So in that context, if that is what is true, that is how we are brought up. In that context, pay for performance, reward for, tenure maybe, or reward for individual performance or business performance or contribution to that, absolutely is the way to go. However, if you feel otherwise, I'll recommend a book to you. It's called Punished by Rewards. It's by 𝐿𝐴𝐾𝐬𝐲. Okay, there is a counter view to this, to say none of this works. It should not be looked at in this manner. So it's called Punished by Rewards. If you have interest, I'm not supporter of that thought process, by the way, I must clarify. But if you have keen interest, do read that book to understand what the perspective of the writer really is. A couple of other things, I think I would say, keeping the plan simple, as Vamsi rightly highlighted. I think what we also do sometimes is, or oftentimes is, we put multiple goals to which we link the plan and the payout.